Institutional investors outperforming retail by up to 5.5% annually according to Delbar. Active traders underperform by 6.5% annually. On 100,000 euros over 25 years, that's a difference between nearly 700,000 euros to 430,000 euros. As a risk analyst, I've reviewed hundreds of institutional portfolios, family offices managing billions, pension funds, sovereign wealth funds. And here's what nobody talks about. They all use variations of the same three structure. Not because some MBA textbook says so, but because of the decades of trial and error, this is what actually works. Trust me, I've seen the disasters when people try to reinvent the wheel. At first, I thought it was a coincidence, but portfolio after portfolio, the pattern was unmistakable. When it's a 2 billion family office in Zurich or CalPERS with 500 billion in California, they divided everything into three distinct categories. And when I saw the research, institutional investors outperforming retail by up to 5.5% annually according to Delbar, I realized something. This structure isn't just organization. It's the difference between professional and amateur results. Today, I'll show you exactly how the pros structure their trillions and how to implement it, whether you have thousands or millions. Quick disclaimer, this is education, not financial advice. I'm here to teach you how to think, not to tell you what to buy. So, I'm sitting in the office and reviewing portfolios. Dozens of different managers, different strategies, different asset classes. And my boss, head of portfolio construction, brilliant woman, shows me something interesting. She goes, look past the assets, look at the purpose. And suddenly, I see it. Every single position, every allocation falls into one of three categories. Not asset classes like stocks or bonds, but purpose-based buckets that transcend traditional categorization. She pulls up Yale's endowment report. Same three purposes. Norway Sovereign Fund documentation. Same structure. Ontario's teacher pension plan. Identical framework. Then she looks at me and says, this isn't taught in universities. This comes from managing real money with real crisis. And you know what? She was absolutely right. Before we get to the buckets, you need to understand the three principles that creates them naturally. And look, I get it. This sounds theoretical. But stick with me, because this changes everything. First principle, purpose before position. Every allocation serves a specific purpose, not growth or income, those are outcomes. Purpose means answering what problem does this money solve. I had a friend who owned 73 positions. I asked him, what problem does position number 47 solve? He couldn't even remember what position 47 was. That's not investing, that's hoarding. Second principle. Time arbitrage. Institutions think in decades. Retail thinks in quarters. This time advantage is worth more than any stock pick. The Norwegian fund states in the documentation, our investment horizon is infinite. Meanwhile, most of us check our portfolios daily. That's like watching grass grow, pointless and frustrating. And yes, I'm guilty of this too. Third principle. Systemic rebalancing. The New York Fed studied this during COVID. Institutions began rebalancing on day 3 of the crash. Retail investors still frozen 6 weeks later. That's not courage, it's system. They don't sit there thinking, should I? They just execute the plan. No emotions, no drama, just execution. Now watch how these principles naturally create 3 distinct buckets that have survived every crisis from 1929 to 2025. And no, this framework isn't perfect for every single person in every situation. But these principles have helped millions of investors perform better than trying to outsmart the market, which, let's be honest, almost never works for regular people like you and me. Bucket number 1. The liquidity management. The first bucket is about returns. It's about never becoming a forced seller. And I've seen too many smart people destroyed because they ignored this. In institutions' reality, pension funds keep 8 to 12% in short-term instruments, not cash sitting idle, but short-term bonds, money markets, treasury bills. Ontario teachers hold 37% in fixed income and cash equivalents. Well, that sounds like a lot until you realize they have monthly pensions obligations in their billions. They literally can't afford to be illiquid. For individuals, this translates differently. Research from the Federal Reserve Bank of Boston shows optimal emergency funds are 3 to 6 months expenses, not the 12 months your anxious uncle preaches. Why? Because every month beyond 6 has diminishing returns on security, but increasing opportunity cost. Your uncle means well, but he's costing you money. Yale learned this painfully in 2008. They had too little liquidity, couldn't meet capital calls from the private equity commitments. Imagine. Yale, with all their smart people, got caught with the pants down. Now, they maintain strictly liquidity minimum. It's lesson? Too little and you're forced to sell at the worst moment. Too much and you're guaranteed to underperform. It's balance. And most of us get it completely wrong. I used to keep way too much in cash. My wife actually had to convince me to invest more. Sometimes the spouse knows best. Bucket number 2. Core wealth engine. This is where fortunes are built. The boring, beautiful, compounding machine. And when I say boring, I mean it as a compliment. Look at institutional allocation. Norway puts 71% in global equities. No trading, no timing, buying and holding 9,000 companies across 70 countries. Their average holding period, 7 years. Average retail investor according to Schwab, 5 months. 5 months. We're not investors, we're tourists. It's like we're speed dating stocks instead of marrying them. CalPERS just reported their public equity returned 16.8% in 2024. But here's what's fascinating. They're actually reducing public equity from 15 to 42% while increasing private markets to 40. Why? Well, because they can. They have access to this investment we can't touch, but that's okay. We don't need private equity to win. We have our own advantages. For individual investors, this bucket should be 70 to 80% of investable assets after emergency funds. But here's where behavioral finance gets interesting and a bit depressing. Barber and Odeon's research shows the more you look at this bucket, the worse you perform. Active traders underperform by 6.5% annually. The top quintile with trading frequency, they turn over their portfolio 258% per year. They basically swap their entire portfolio twice a year and wonder why they're broke. I know a guy who did this. Smart engineer, terrible investor. He showed me his trades like were trophies. 10 years later, he's still working, while his buy and hold neighbor retired early. The solution institutions use: set allocation, automate investment, review quarterly. That's it. Not through genius stock picks, through disciplined, systemic, boring execution. Boring is beautiful when it comes to wealth. My most successful investment? A stock I forgot in an investment account I owned for 8 years. True story. Bucket number 3. Tactical opportunities. This is the professional secret. Dry powder for disruption. And no, this is not your gambling money. Let me be crystal clear. Harvard Management Company demonstrate this perfectly. While retail investors panic, they deploy tactical reserve into distressed assets. They achieve massive returns in months, not years. Months. The Singapore GSC maintains what they call policy portfolio reserve specifically for market dislocations. They are literally waiting for chaos, and chaos always comes. The research is compelling. McKinsey found out that institutions with 5 to 10% technical reserve outperform by 180 basis points annually over 20 years. Not from brilliant market timing, but from having capital when others don't. It's like being the only person with cash at a fire sale. For individual, this is not day trading money. The Cambridge Annals of Actual Science studied retail tactical allocation. 90% who try active trading underperform. But those who deploy capital only during significant corrections, they add 2.3% annual alpha. The key word is significant, not every 5%. Think about spring 2025. President Trump imposed sweeping new tariffs, triggering a sharp market sell-off. Tech stocks plummeted, the VIX soared to levels not seen since the pandemic crash. Markets dropped over 12% in just a couple of weeks. The Nasdaq fell even more. If you had bucket 3, you bought the fear, while most portfolios, either locked in emergency funds or fully invested, could only watch. My neighbor literally texted me, "I wish I had cash right now." Then the rapid rebound. The administration paused new tariffs and announced the truth. Market surged, climbing back nearly 50% from the lows. The institutions with tactical reserve, they took full advantage of the chaos. Scale doesn't matter, principle does. UBS Family Office report shows ultra-wealthy families keep 11% in opportunistic allocations. Not speculation, ammunition for disruption. They're not smarter than us, they're just prepared. And preparation beats intelligence every time. Let's quantify what this structure actually delivers. And prepare yourself because these numbers hurt. They hurt because they show what we're leaving on the table. Investors using three-bucket approaches. Well, Vanguard research shows they capture 94% of market returns versus 76% for unstructured portfolios. On 100,000 euros over 25 years, that's a difference between nearly 700,000 euros to 430,000 euros. That's basically €250,000 difference. Same market, same time frame, different structure. Let that sink in. €250,000 just from having buckets, not from picking the next Amazon. Just structure. The psychological benefit might be even greater. The Journal of Behavior Finance tracked investors through the crisis 2008. Those with clear bucket strategies had cortisol levels 40% lower during market stress. Lower stress equals better decisions, equals better returns. It's not just maths, it's biology. Your body literally thanks you for having a system. Real-world example, and this one's personal. Two colleagues of mine both started investing before the financial crisis, both with around 50,000 euros. One dumps everything in stocks, rides the roller coaster, panic sells in 2009, tries to time to re-entry. Today's value about 100,000 euros, 95. The other uses three buckets. Rebalance quarterly, deploys technical during crashes. Today's value, 235,000 euros. Same starting point, same timeline, different structure. And the first guy still thinks he's just unlucky with timing. No, mate, you're just unstructured. Here's the action plan. And please, actually do this. Don't just watch and forget. I see too many people consume content without taking action. Calculate your buckets. Liquidity. 3 months if you're aggressive, 6 if conservative. Not 12, that's fear, not prudence. The core bucket. 75% of remaining. Global exposure, embrace the boring. This is your wealth engine. Treat it with respect. The third bucket, tactical, 10 to 50%. Higher if you have discipline, lower if you're emotional. Be honest with yourself. And remember, this is your money, your rules. You don't have to implement everything tomorrow. Start with what feels comfortable. Maybe that's just setting up your emergency fund properly. Maybe it's finally automizing your investments. The pace is yours to choose. The important thing is starting, not being perfect. Automate everything. Liquidity stays in high-yield savings or money markets. Core gets monthly automated investment. Set it and forget it. Tactical builds slowly, deploys rarely. This is your patience fund. Quarterly rebalancing. Mark your calendar. March 31, June 30, September 30, December 31. Takes 50 minutes. I do mine with the morning coffee. Check if buckets drifted more than 5%. If yes, rebalance. If no, close the laptop, go live your life. Crisis protocol. When markets drop 20%, deploy 25% of tactical. When it dropped 30%, deploy another 25%. This isn't timing, it's systemic response to volatility. You're not predicting bottoms, you're exploiting fear. That's a big difference. The evidence is overwhelming. 3-bucket structure, it's 1.5 to 2% annual returns, by reducing volatility by 30%. That's not opinion, that's institutional data from decades of implementation. Every major institution on Earth uses some variation of this 3-bucket system. Not because they're smarter than you, they're not, but because structure beats intelligence every single time. Now, you have the same framework managing trillions globally. The framework that survived 1929, 1987, 2000, 2008, and 2020. The only question, will you implement it or remain part of the underperforming majority? Look, I want to thank you for being here, for taking the time to learn this stuff. I know, finance content isn't exactly entertainment, but the fact that you're watching means you're serious about your financial future, and that's honestly inspiring to me. If this framework opened your eyes, and I really hope it did, please Support the channel. Hit subscribe, hit like. It costs you nothing, but helps me reach more people with this education. Share it with the one friend who's fully invested, all the time. The crash might be their own financial future if they don't get structured. We all know someone like that. They need this. Thank you again for your time and trust. Remember, structure beats genius. Every single time. See you in the next one.